AI likes adventure too, because GoPro announced that its opt-in AI training licensing program has attracted over 125,000 hours of subscriber video content in just over 2 weeks since its initial limited rollout. The program, which allows users to contribute their cloud-stored footage to help train third-party AI models, has garnered significant interest from subscribers. GoPro plans to expand the program across the US and potentially internationally, leveraging its vast library of user-generated content. With 2.45 million subscribers and 13 million hours of content in its cloud, the company is well-positioned to capitalize on the growing demand for authentic, real-world video content to enhance machine learning systems. Subscribers who opt into the program will receive 50% of the licensing revenue generated from their videos, providing a potential new revenue stream for the company. CEO Nicholas Woodman praised the early response, calling it a promising sign for long-term impact. GoPro is currently in talks with multiple AI data licensees to meet the rising demand for high-quality video content. The AI training licensing program is being viewed as an innovative approach to monetizing user-generated content, and its success could have a positive impact on GoPro's business. Meanwhile, educational tech is transforming into a turbulent land with intense competition spurred on by AI. Just ask Chegg, which is navigating a challenging period marked by significant subscriber losses, with its subscriber base plummeting 40% to 2.6 million. This decline is largely attributed to lower traffic stemming from Google's AI overviews. Despite these challenges, the education technology firm reported second quarter 2025 revenues of $105.1 million, down 36% year-over-year, with subscription services revenue falling 39% to $89.7 million. However, Chegg's management is betting on its artificial intelligence to reshape its business model and stabilize the company. The firm has embedded AI across its Chegg study platform, launching innovative tools such as Solution Scout and AI-driven flashcard generators. These AI-powered innovations are reportedly improving engagement, with gains in retention and satisfaction. Moreover, AI is helping reduce operating costs, with non-GAAP expenses falling 33% in the second quarter. This cost-cutting measure has enabled Chegg to deliver $23.1 million in adjusted EBITDA despite revenue headwinds. The company's growth segments, Busuu and Skills, are also showing promising results. Busuu's language learning platform posted a 15% revenue growth, led by a 39% surge in its B2B business, while Skills, focused on workplace readiness, saw a 16% enrollment growth quarter-over-quarter. These businesses are positioning themselves as long-term growth drivers for the company. However, Chegg's challenges are compounded by intensifying competition from peers like Coursera and Duolingo. Coursera has leaned into AI-driven personalization and enterprise partnerships to expand beyond its core university alliances, building traction in professional upskilling, a direct overlap with Chegg's Skills business. Duolingo remains a formidable player in language learning, boasting a massive global user base and strong brand equity. The company has aggressively integrated AI to refine language instruction and has also branched into math and literacy, broadening its moat against niche players. Looking ahead, Chegg's management guided third-quarter revenues down to $75 to $77 million, reflecting ongoing traffic pressures. While cost discipline and AI-enabled efficiencies are cushioning profitability, the key question for investors is whether AI can drive sustainable growth in a competitive, AI-disrupted edtech landscape. With Chegg in the midst of a strategic review, the next few quarters will be critical in proving whether efficiency gains can offset declining scale. The company's ability to leverage AI to drive growth and stay competitive will be closely watched by investors, particularly given the competitive pressures from edtech rivals like Coursera and Duolingo. Into the new year, it'll also be exciting to see whether Rail Vision can stay on track after it received a notification from NASDAQ granting an additional 180-day compliance period until March 2, 2026, to regain compliance with the minimum bid price rule. The company's ordinary shares were below the $1 minimum bid price requirement for 30 consecutive business days, but NASDAQ's determination is based on Rail Vision meeting the continued listing requirement for market value of publicly held shares and all other applicable requirements for initial listing on the Nasdaq Capital Market. Rail Vision didn't regain compliance during the initial 180 calendar day compliance period, which ended on September 2, 2025, but has been granted an extension to cure the deficiency. If the closing bid price of Rail Vision's ordinary shares reaches at least $1 per share for a minimum of 10 consecutive business days before March 2, 2026, the company will regain compliance with the Nasdaq rule. Rail Vision's CEO, David Ben-David, expressed confidence in the company's potential to transform rail's safety and efficiency, pointing to growth in certain areas, such as securing a $335,000 follow-on order from a leading Latin American mining company and signing a binding memorandum of understanding with Sujin Ventures to introduce its advanced safety systems to the Indian market. In the first half of 2025, Rail Vision reported a revenue decrease of 69% to $237,000 compared to the same period in 2024, primarily due to the timing of revenue recognition. Research and development expenses increased to $3,241,000, while general and administrative expenses rose to $2,512,000. Operating loss for the 6 months ended June 30, 2025, was $5,705,000. Rail Vision has strengthened its balance sheet with cash and cash equivalents of $22.4 million as of June 30, 2025. The company believes it is well-positioned to expand its market reach and remain at the forefront of innovation in the rail industry. Exactly the kind of attitude this train needs to stop falling off the rails. Beside the train tracks, ChargePoint recently reported its second quarter fiscal year 2026 results, ending July 31, 2025. The company's revenue reached $98.6 million, down 9.2% from the same period last year, but still managed to exceed analyst estimates by 3.4%. However, earnings per share missed analyst expectations by 27%, with a loss of $2.85 per share. Despite this, the net loss narrowed by 3.9% year-over-year to $66.2 million. Cash management was strong, with an ending balance of $195 million, only $2 million below the previous quarter. ChargePoint's collaboration with General Motors is progressing well, with nearly 12 sites and over 50 new fast-charging ports. Additionally, the partnership with Eaton is expected to accelerate the deployment of electric vehicle charging infrastructure across North America and Europe. ChargePoint's competitive edge lies in its ability to combine express chargers with Eaton's electrical infrastructure solutions, allowing for synchronization between on-site renewable energy storage and vehicle batteries to reduce fueling costs. The company recently unveiled a new ultra-fast charging architecture designed for passenger electric vehicles, capable of delivering up to 600 kilowatts of power. This system also features vehicle-to-everything (V2X) capabilities and a modular DC grid design, making it more efficient and cost-effective. However, the company faces challenges, including slowed passenger EV sales growth in the U.S. and the expiration of consumer tax credits, which may impact future demand. ChargePoint has pushed out its target for non-GAAP adjusted EBITDA breakeven beyond this year due to revenue delays. To address these challenges, ChargePoint is prioritizing efficiency initiatives, including reducing operating expenses and restructuring sales and marketing. It's also investing in product and technology innovation, such as next-generation products and AI-driven diagnostics, expected to improve gross margins and expand its addressable market. Potential catalysts for growth include the conversion of delayed fleet deals to revenue, rollout and adoption of new hardware and software products, and signs of stabilization or renewed growth in the broader EV charging market. Electrifying stuff if it does happen. For more on stocks and crypto, follow Ascencore. Thanks for watching, and have a nice day.